All right, AP Econ, there are only 2 sections to go, and this is the second to last section. This is 7.4, monetary and fiscal policy effects with an open economy. Remember, an open economy is an economy that has international trade. All right, so our goals, you can see, it's to explain the effects of monetary and fiscal policy on foreign exchange markets. We're going to look at the effects of changes on the international value of the dollar on foreign trade, and then also look at the effects of changes in net exports on domestic aggregate demand. So what we're basically going to see is how all these things kind of interact. So just as a reminder, everything is connected. There is a link between a country's domestic monetary and fiscal policy and its balance of trade and exchange rates. Monetary and fiscal policy affect exchange rates and its balance of trade through their effect on real interest rate, income, and price level. So let's suppose the US government raises spending to stimulate the economy in, I don't know, in case of a pandemic or something, maybe people need some money because they've lost their jobs. So let's suppose the government raises spending to provide more money for its citizens and its people. That's going to require government borrowing to increase because the government doesn't have a balanced budget. To spend more money, they got to borrow more money. To borrow more money, they got to go to the loanable funds market. That's going to increase the demand for loanable funds. The higher demand for loanable funds causes real interest rates to increase. Now, real interest rates increasing affects capital flow because remember, foreigners are going to invest in the country with a higher interest rate. So that higher interest rate now is going to attract foreign investment. Capital inflow is going to go up. That's going to mean foreign investment goes up. It increases. To invest in American assets, that means foreigners need to demand American dollars. So the demand for dollars increases, causes the exchange rate for the dollar to go up, and the dollar appreciates. Since the dollar appreciates, it's now higher. Now foreign goods look relatively cheaper because American dollar is stronger, so imports increase. Meanwhile, American goods seem more expensive now because of the appreciated dollar, so exports decrease. So you can see how everything kind of relates. Now let's look at monetary policy. Suppose the Fed decides to lower interest rates to stimulate the economy by buying bonds. I don't know, in case they buy bonds or cancel the reserve ratio, which is what they just did actually. Lower interest rates mean now investment from abroad is going to decrease. Remember, foreigners are going to invest where the higher interest rate is. So that's going to decrease capital inflow to America. As a result, the demand for the dollar goes down. Since the demand for the dollar goes down, that's going to cause the value of the dollar to depreciate. Since the dollar depreciates, now American goods are relatively cheaper to foreigners, so exports will increase and imports will decrease. Now let's look at the effect of foreign exchange on the domestic economy. If the US dollar appreciates, it makes American goods look relatively more expensive. So here we go, follow the chain. Since the dollar appreciates, American goods are more expensive to foreigners, that's going to cause exports to decrease. Since exports decreases, that's a part of net exports. Net exports will also decreases, which leads to, by the way, a current account deficit, which leads to a financial account surplus. Because net exports is a component of GDP and AD decreases, so AD shifts to the left, thereby price level and real GDP also decrease. Now, for example, if the dollar depreciates, it makes American goods relatively less expensive, makes it more desirable for foreigners to buy American goods. So the exchange rate of the dollar goes down. That actually increases American exports because American goods are relatively cheaper. That's going to increase net exports, which results in a current account surplus. That leads to an increase in aggregate demand, which leads to an increase in price level and real GDP. So you can see how all these things are interrelated. Now, on a test question, they'll usually hone in on something, and they're going to want you to try to make the chain. They'll pinpoint something they want you to focus on, and because if you just leave it open-ended, these can go in many, many different directions. So that's all for section 7.4. I'm going to ask you to look at activity 7.4, and I'm going to go over the activity right now, and you can follow along after you do it, or you just want to use it as notes, you can do that too. In activity 7.4, you're going to use the graphs to show the starting equilibrium of exchange rate and equilibrium quantity of currency, the shift that ends up occurring, and the new equilibrium exchange rate and quantity. And there you're going to see what the short run effect is on the change in the foreign exchange market on net exports, aggregate demand, and price level in the US. Okay, so we're just going to worry about the current account now, worry about the financial account in the next activity. So number one, we are told that Japanese real output increases. Since Japanese output increases, they have more income. That means they're going to demand more stuff, including U.S. goods. So they're going to demand more U.S. imports. To get those imports, they're going to demand more dollars. So the demand for the dollar increases, thereby strengthening the dollar. To get those dollars, they're going to have to supply more yen, thereby the value of the yen decreases. So now we'll go through parts A, B, C, and D. U.S. imports are going to increase because the dollar buys more yen. Japanese goods are now relatively cheaper, so Americans are going to buy more stuff from Japan. U.S. exports will also increase because now that the Japanese have more income, they will spend more on imports. Now you're probably wondering, wait a minute, but if the dollar appreciates, won't that actually decrease exports? And the answer is yes, and that's the second part. The increase is offset somewhat by the appreciation of the dollar and the effect that it'll have on exports. 1C, what happens to U.S. aggregate demand? Since net exports increases, that's going to cause aggregate demand to shift to the right. And because aggregate demand shifts to the right, price level goes up and real output also goes up. Okay, example 7.4, number 2, we're going to look at a real interest rate increase in the United States relative to Great Britain. So now the higher U.S. real interest rate makes investing in the U.S. more appealing. British investors are going to want to invest in American assets. So to get those American assets, they need to exchange their pounds for dollars. So that's going to increase the demand for U.S. dollars from the Brits, causing the dollar to strengthen. To get those dollars, they're going to have to supply their pound sterling. That's going to increase the supply of pound, and that's going to decrease the exchange rate for the British pound sterling. So because of the stronger dollar, U.S. imports increase because now the dollar is a better value to buy foreign goods. So British goods are cheaper than U.S. goods, so imports from the UK will increase due to the stronger dollar. At the same time, U.S. exports will now decrease, and this is what you would expect because the dollar is stronger. It's going to cost British more pounds to buy American stuff, so American goods are relatively more expensive, so that's going to decrease American exports to the UK. All right, so since imports increases and exports decreases, we know there's a definite negative effect on net exports. So as a result, aggregate demand shifts downward to the left. Since aggregate demand shifts to the left, that's going to cause the price level to go down. Number 3, recession in Europe. So because of a recession, Europeans have less income, which means they're going to buy less stuff across the board, notably less American goods. So that means they're going to demand fewer dollars because they don't need as many to buy American goods. So the demand for the dollar decreases, weakening the dollar, and at the same time, the supply of euros decreases because they won't need to supply those euros to get those dollars they don't need anymore. So the euro gets stronger. The US dollar depreciates, the euro appreciates. Since the dollar has depreciated, that's going to decrease US imports. European goods are now relatively more expensive, which causes American imports to fall. At the same time, US exports will decrease. Now you might wonder, wait a minute, the dollar is weaker, that should increase exports. Well, except for the fact that European incomes have declined. So you can see how some of these questions have multiple plausible answers, and as long as you kind of follow something logical, it'll probably work. So you could argue that, well, exports decrease because European incomes have declined, so there's less demand for American goods, lessening exports, and that might be more than the effect of increased exports due to the weaker dollar. So there's some wiggle room here, and it's not always so cut and dry, but if you give a reasonable response, then it's totally fine. So aggregate demand is likely going to go down. Imports goes down and exports goes down, so we don't really know just from that the effect on net exports, but the decrease in imports due to the new exchange rate is unlikely to offset the decrease in exports due to the European recession. In other words, the recession effect is going to be much stronger than the effect of the exchange rate because overall Europe is just going to buy less stuff overall, and yes, even though the dollar is weaker, makes American goods more attractive, it's probably not enough to overcome the recession that is in Europe. As a result, net exports goes down, aggregate demand goes down, which means price level goes down. So that's number 3. Number 4, the price level in Canada increases relative to the United States. So because the prices are now higher in Canada, Canadians are going to look towards American goods because now American goods are relatively cheaper. To get those American goods, they're going to need more American dollars. So that's going to increase the demand for the US dollar, strengthening the dollar. That'll increase the supply for the Canadian dollar to get those American dollars, weakening the Canadian dollar. So the US dollar appreciates, the Canadian dollar depreciates. So what happens to US imports? They're going to decrease. Since the dollar has appreciated, Canadian goods are now relatively more expensive, so fewer Americans are going to buy them. Americans are going to demand fewer of those more expensive Canadian goods. US imports will also increase. Now, again, you could argue that it'll decrease because the dollar's stronger, but keep in mind that there's nothing about a Canadian recession. And again, you might have plausible different answers. But let's just go with this. Canadians want more American goods because now American goods are now relatively cheaper due to the higher price levels in Canada. As a result, they're going to buy more American things, which will increase American exports. So, since exports goes up and imports goes down, aggregate demand will increase, which means the price level also increases. Number 5, the effect on Taiwan if the US government decreases taxes. So let's go with the lowering of US taxes means more disposable income from Americans. That's going to increase the consumption and investment for Americans, which will increase aggregate demand in the American economy. That increases the price level. So now American goods are relatively more expensive than Taiwanese goods. So now Americans are now going to look to Taiwan to buy some of Taiwan's goods. So that's going to increase the demand for the new Taiwan dollar, which is in the graph on the right. And that's going to increase the supply of US dollars, which is the graph on the left. As a result, the Taiwan dollar appreciates, the US dollar depreciates. Now you might be wondering, well, price level goes up, but doesn't income go up? Because output goes up, so couldn't we do it that way? All right, so let's go that way. Let's suppose, instead of looking at the price level increasing, let's suppose American real income increases, which means more money. They're going to buy more stuff, including buying more stuff from Taiwan. If they're going to buy more stuff from Taiwan, that's still going to increase the demand for Taiwan dollars, which is still going to increase the supply of US dollars. So regardless of whether you're looking at the change in price level or the change in real output, the ultimate outcome is the same. The dollar depreciates against the new Taiwan dollar. Due to the lowering taxes, US imports are going to increase. They're going to buy more stuff everywhere, including Taiwan. Now the US exports will arguably decrease because now the American price level is higher, Taiwan's going to buy fewer American goods. Now again, you could conceivably argue the other way. You think, well, the dollar's weaker, won't that mean foreigners are going to buy more American stuff, which will actually increase US exports? Yes, it is very possible. So again, some of these questions could conceivably go either way. So they'll often pinpoint and focus on something like US exports. Or they'll say, given the change in price level, what happens to US exports? Instead of, for example, looking at the change in exchange rate, what happens to US exports? So they'll focus on one aspect of the economy, of the change, and have you address that in your answer. So US aggregate demand increases, going all the way back to the lowering of taxes, which increases disposable income, which leads to a higher consumption and investment. Because aggregate demand increases, price level also increases. So that's section 7.4, how the changes in the exchange rate affect domestic price levels, domestic output, etc. If you have any questions, feel free to post on the Google Classroom, join me in a chat, or email me.